be very missed here. I have some concerns when I think about, I know you've touched on this a little bit through the questions today, but around the independence of the Federal Reserve. Your job, no matter what president you served under, Republican or Democrat, was to make sure that this was not a political position while you brought news that some would not be happy about because it reflected what you had to do to address inflation. You know, when I think about the conversations we've had going through the global pandemic and the economic fallout and how we had to infuse money throughout our country to keep our services afloat, our businesses afloat. And while we suffered from inflation like the rest of the world, we had the quickest, strongest recovery. We were leading the globe. And so much of that was because of your leadership. And so when I think about what this position means, how important it is that there is independence, what are your biggest concerns about a potential successor that doesn't prioritize that and wants to do what is politically asked of them versus what they need to do for the country? And what are their long-term repercussions if you're not acting on addressing the economic uncertainties and trying to address inflation in this position?
So I wouldn't speculate on that, but I would say, you know, the credibility on the Fed on price stability is very, very important. People believe that we will bring inflation back down to 2% over time. And once if they really do believe it and it's true, then, you know, that'll have big effects on not just short-term rates, but long-term rates. If that were to be called into question, then you'd see long-term rates go up. I mean, that credibility once lost is very expensive to regain, is what the historical record says. So I just think I think people should understand that you know, credibility on inflation is hard won and something we need to constantly tend. And you know, that's what we're doing with our current policy, is just being careful with potential inflation risks. We haven't overreacted. In fact, we haven't reacted at all. But we're being a little bit careful about that set of questions as we decide what to do next.
And thank you for bringing that up. As we look at where we were, how far we had come in our economy, things were starting to stabilize, and we were starting to finally see a relief on the interest rates. They were starting to go down. Now they're holding steady. Can you talk about why the instability, you know, when we look at tariffs around the increase in the deficit by the proposed big ugly bill that is being brought through Congress right now, and increasing our debt by trillions of dollars, and having our credit downgraded again because we are increasing our deficit. So with this economic uncertainty, where we were going, we were on the way down for reducing our rates, and now we have to hold steady to address the instability. Is that correct?
I'm sorry, could you just briefly restate your question there? I apologize.
Yes, I'm going to do this as the best I can with with Sam here. That with our having to address inflation, as we've started to see it, you were able to decrease the rates. We were starting to go down a little bit. We were seeing that our economy was finally in a solid place. Prices were starting to go down. And now with the economic uncertainty, we're starting to see that you had to hold steady, whereas everyone was projecting before this administration came in with these changes that it was going to continue to go down. Can you talk about why you have had to choose to hold steady on the interest rates?
So we just, you know, we stick to what we're assigned to do, which is maximum employment and price stability. We don't have opinions on fiscal policy or trade policy or immigration policy or any one of another, or regulation policy, other than we have our regulatory responsibilities. And so we take what comes as it comes. And, you know, elected politicians do what they do, and we don't criticize that. We don't have opinions about
Gentlemen's time has expired, and the gentleladies.
Thank you, and thank you, Sam.
Chair now recognizes the gentlewoman from Texas, Mrs. De La Cruz, for 5 minutes.
Thank you so much. And thank you, Chair Powell, for being here with us today. I am Congresswoman Monica De La Cruz, and I am from deep South Texas, a largely Hispanic district, a rural community right there on the border of Texas and Mexico. I serve as the Vice Chair for Housing and Insurance Subcommittee, and it's difficult for families right now to afford a home on an average paycheck. I'm committed to finding affordable housing solutions for the people in my community, but also for all over the nation. So, Chair Powell, mortgage rates remain significantly elevated relative to Treasury yields, with spreads well above historical norms. To what extent does the Federal Reserve believe its balance sheet policy, particularly the runoff of MBS holdings, is contributing to this widening? And how does that factor into your broader assessment of financial conditions?
I don't think that our runoff of MBS is a particularly large contributor to that situation. I also think it's not just interest rates. It's so many things around housing now. It's insurance, it's materials, it's land acquisition, it's labor. There's so many cost pressures that are pushing up housing costs.
Thank you. With that being said, moving on to an entirely different topic, if the Federal Reserve focuses on issues outside its dual mandate, there are more opportunities for policy mistakes. How can you ensure that no other climate policy work is being done at the Federal Reserve?
So it is a big risk to our independence if we were to stray into areas where we shouldn't, that really aren't part of our mandate. And I would agree that climate is the biggest risk. So we really did the bare minimum. We did much less than I think people understand in the climate area. All we did was one piece of guidance, and then we ran one stress scenario, and by the way, didn't find anything. And I think you don't look to us to try to take on a bigger role or really to play any role in climate, which I personally think is an important issue and one that needs to be dealt with by elected officials. And for bank regulators just to step in and take that on without a mandate from Congress is not a good idea. It's not a good solution, and it's not a good way to remain independent.
Reclaiming my time, what kind of climate guidance did you make?
So for just the big banks, I believe, we asked them to monitor to have a framework for which they would monitor their risks from lending. That's all it was. And I would say that that guidance is something we're looking at pulling back.
When you say the risk for lending based on political climate change, is that correct?
Well, the idea was that the changing climate could. I mean, I'm not defending this. I'm telling you what the idea was. The idea was, climate change would cause certain kinds of assets to lose value, and that if banks are lending to in those areas or to those industries, then they should at least be able to measure. Didn't ban anybody from doing anything. It wasn't prescriptive. At the same time, you have the feeling that the side effect of it would be to discourage lending, and we don't want that to be the case. So that's why we're looking at it.
Well, it does sound like that is policy that is based on political agenda. And when it comes to banking, it should not be based on political agenda, but instead on facts such as credit, facts as good monetary policy. So I would have to disagree with you on the fact that the Federal Reserve stayed outside of political agendas. When it comes to climate change, that is a political agenda, and I would have to disagree with you on that. Thank you. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from California. Mr. Sherman is also a ranking member of the Capital Markets Subcommittee for 5 minutes.
We don't notice good bank regulation. Things just go smoothly. But in 2023, we saw the effects of inadequate bank regulation where we lost 3 banks. There was a proposal that passed the House that would have cut the pay rate of your bank inspectors, regulators, down to 70% of the rate paid at FDIC. So you would have been the 70% of what the other major bank regulation agency did. I know you've announced things about headcount, but I'm focusing here on just the rate of pay. Fortunately, we were saved by not Superman, but Superwoman, Elizabeth McDonough, the Senate parliamentarian. But what effect would it have had on our ability to have good bank regulation if you had to go to all the folks in doing bank regulation at the Fed and say that their pay is going to be cut to 70% of the rate of pay over at the FDIC?
Would have made it harder for us to attract or to retain personnel. It also would have knocked down something we've had for 90 years, which is a sort of a moat that allows us to take care of HR issues on our own without Congress.
Gotcha. There've got a couple of questions I'd ask you to respond for in the record. The first is Section 899 of the big ugly bill, big beautiful bill, whatever you want to call it, enforcement of remedies against unfair foreign taxes. What this does is it imposes a tax on those residents of about 24 foreign countries should they invest in the United States, including in our treasuries. And we're trying to attract capital from abroad. This is to push out capital abroad. It doesn't affect China. It just affects 24 of our friends, particularly in Europe. The other thing I'd like you to respond for is the record is the tariffs and the effect that that has not only on the inflation rate, but therefore on interest rates. And at your press conference, you said increases in tariffs this year are likely to push up prices and weigh on economic activity. And I'd certainly like to know more about that. The Treasury has our reserves, but you also have a liquidity fund, which I believe involves buying and selling foreign currencies. And so that begs the question whether if you're allowed to buy the euro, whether you're allowed to buy cryptocurrencies. And of course, the president has said that some agency of the federal government should have a strategic crypto reserve. Do you or your successors have the legal right to take assets of the Fed and buy Bitcoin or Trump coin?
No, we don't, and we do not seek this authority.
I hope very much that your successor is not someone who tries to stretch existing statutes and come to an opposite answer. I'd like to focus a little bit on when you came before our committee last, I guess, in February. I asked you if you would take a holistic look at bank capital requirements, including the risk-based capital ratios like Basel III Endgame and stress testing to make sure that you don't have a contraction in the ability to provide credit to Main Street businesses. And you said you would do that. So my question this time is, how does the Fed plan to sequence the various capital requirement reform proposals that we expect to see in the coming months? In what order will you proceed with reforms on Basel III weight risk capital, leverage ratio, stress testing, and the GSIB service charge, knowing that these have interactive effects? Can you tell us what the sequence will be?
So I really do. This is the heart of what the Vice Chair for Supervision is assigned to do, is to bring proposals to the board. And I read that as giving her she's the one who will decide that sequencing. You're right there. There are many things, and it's really up to her to decide what's the timing, what's the priority. And I don't actually know exactly what she's only been confirmed for a couple of weeks. So we're just getting going.
With you as the head of the agency, even if she is supposed to decide the sequencing, that your agency would tell us what the sequencing is going to be. and understand how important it is for people to know what the order, those various regulations
Gentleman's
will
time
have,
has
and I
expired.
yield back.
Gentleman yields back. The chair now recognizes the gentleman from Iowa, Mr. Nunn, for 5 minutes.
Well, thank you, Mr. Chairman, and thank you, Chairman Powell, for joining us again here. We have a saying, Iowa is nice, kind of boring. We want our Fed chairman to be just the same, and you're doing a great job at that. We appreciate it.
Thank you.
Nothing gets boring. We like that too. Look, you have a lot of great staff that come from Iowa as well. I appreciate you having them on your team. We also want to recognize the fact that, folks in Iowa are still feeling the challenges of the last 4 years. We're middle America. It is the heartland of the country, but it also means that impacts that change things on the coast don't always get felt the same way in the Midwest. And so as a result, folks are stretching every dollar as they face everything from higher grocery prices, eggs, to trying to buy just that first car or even maybe that first home. And interest rates to them matter as they do everywhere else, but they're even more. Now, I will offer the president has made great strides in making progress for Iowa families, and wage growth is moderating nationwide. Many Iowans still feel, though, that inflation spikes impact them. And with the president focused on rebuilding the middle class, I'd like to talk a little bit about how the Fed ensures that this heart of the heartland can feel the benefits of a soft landing as you've laid out.
Oh, you're asking me how you will feel the benefits of the well, I would think pretty open-ended question. So I think, our goal is to keep the economy strong, the labor market strong, and price stability fully restored. So that's really what we can provide, is a long period of stable prices. And we define that as Chairman Greenspan used to, which is people can make economic decisions in their families and their jobs where they don't have to think about inflation all the time. And we're getting back closer to that place, but we're not quite there yet. That's the main thing we can now do. And once we restore price stability, very soundly, that gives us the ability to react more strongly to downturns in the economy without having to worry about inflation. And so that's, we have limited scope, but those are two very, very important things that we can deliver that benefit all families.
I would agree. So I guess I would also like to focus here on the short term. The Fed Reserve has slightly lower rates to ease borrowing costs for rural communities, and long-term trade negotiations strengthen our global position. Would you agree that the agricultural sector in particular is vulnerable to both interest rates and recognize international markets? And how would the Fed evaluate the unintended consequences of policy on commodity-dependent economies in a state like Iowa?
So we have a number of our Federal Reserve Bank presidents represent districts which have extensive agricultural operations and families and farms. And so we hear from them kind of all the time, but we hear from them in great detail around every FOMC meeting. And we understand that times, pretty challenging right now in the agricultural sector. We take that into account. Ultimately, we're responsible for the aggregate level of the economy and for keeping inflation under control and maximum employment. So, but we do very much think about and take into consideration the agricultural sector and the people in it.
We appreciate that evaluation. I know there are farmers back home as well as, our bankers who value that because they're the one providing the capital for it. I want to talk a little bit on the national security side as the vice chair of NATSEC here. If foreign actors begin weaponizing treasury sales or dollar reserves, what tools does the Fed have to help preserve financial stability and the dollar's status as a reserve currency within the world?
Essentially what makes us the reserve currency is a few things. It is our great democratic institutions. It is that we have open capital markets, very open capital markets. And it is that we have price stability and the rule of law. Those are the things that make you the reserve currency. And you can keep that status as long as you maintain those things. Of those things, the thing that we contribute is price stability over the long run. So people who want to invest in or use the dollar, they can be confident in the value of the dollar over time, that it won't fluctuate wildly or decline in ways that, and so that's our role. Really, Treasury is responsible for stewardship of the dollar, but we have that role to play as well.
Very good. In the brief time that I have left here, I just came back from a trip to Saudi and the Arab states. Big concern here in the world we're living in right now with Iran looking at asymmetric ways to threaten the United States. cyber attacks have been on the rise. You got a question here earlier on cybersecurity. Help us feel confident the Fed is doing everything they can to protect us from a cyber threat.
So our part of it is the financial sector and the institutions we regulate, and they spend a lot of time and money on cybersecurity. We spend a lot protecting ourselves, and there are other parts of the U.S. government that are very much involved in
Gentleman's time is
making us
expired.
aware of cyber issues and making sure that we're all ready. And we never sleep on this because it's always getting harder.
Thank you, Mr. Chair. I yield my time.
Gentleman's time has expired. The gentleman from California, Mr. Vargas, who's also a ranking member and my colleague on the Monetary Policy Task Force, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. Thank you, Ranking Member. Appreciate it. And of course, Mr. Powell, thank you very much, Chairman Powell, for being here. I'm 64 years old. You're a little bit older than I am. In my lifetime, I know what the most dramatic economic event is, at least that I believe. In your lifetime, what do you think is the most dramatic economic event that you lived through? As a country, as a world?
So as an adult, I would say the global financial crisis and the pandemic.
No, just one. You get to pick
big
one.
events. Sorry?
You get to pick one. You pick two, just one.
I would say there's a third, which would be the great inflation. So I'm going the wrong way here.
You're going the wrong way. Yeah, just pick one.
I'd say the global financial crisis was in a lot of ways scarier than the pandemic for me.
Yeah, it's interesting because both of them were ones that I lived through too. And I have to tell you, the most dramatic for me was the pandemic. In so many ways, I'd never seen anything like it, where everything closed down. I remember flying here from San Diego, where I live, on a 737, and there were 4 passengers. There were 4 of us on the plane. Of course, some idiot sits right next to me. I tell, what are you doing? You stupid, move away. But anyway, it is interesting that we didn't fall into the recession. We didn't fall into a depression. I was really scared about what was going to happen because of the way we closed down. We didn't know it was going to go. We didn't know it was going to happen. And I think a big reason for that was the sort of the strength that we had of the Fed, and the country came together and said, we're going to figure this thing out. And we did that. You didn't panic. You guys were very independent. I think everyone did their job. The reason I say that is because I do worry about the independence of the Fed now going forward. So question, can the president appoint himself as the Fed chair?
It's a question, but not for me.
You're the Fed chair. You should know. You should know what the requirements are to be the Fed chair. Can he appoint himself?
I don't know.
You don't know that question? What is, well, you're the Fed chair. What is the requirements to be the Fed chair?
Nominated by the president, confirmed by the Senate. I think you probably have to be a U.S. citizen probably, but I'm not sure.
Okay, so far it seems like the president fits those. He's a U.S. citizen. He can propose himself, and I assume that the senators over there could confirm. Why couldn't he become the Fed chair also?
Again, not a question for me.
Okay.
I wouldn't speculate.
The reason I ask that is because, again, I do think that we have a great system because of the independence of the Fed. And it worries me that more and more, and I assume, I'm not going to ask you this embarrassing question, although I would like to, whether you read all the things that he says about you. I'm sure you do, or some people tell you. Yeah, but I won't tell you what they are. But I'm glad you've been independent. And I think that that's so important because you do look at long terms. It's not missed on you. You know that we want you all to lower the rates. You know that, both sides, right? You get that. The answer could be yes or no.
Honestly, I'm not sure I do know that. I talked to a
Well,
lot
I
of
can
members
tell you, from our side,
privately.
we'd love to see the rates go down. And I've heard from a number of my colleagues on the other side, we'd love to see the rates go down.
I talked to
I
a
think
lot of
they pretty
members who
unanimously
say
would like to see it.
privately, you're doing the right thing. I hear that from a lot of members privately.
Yeah, oh,
But in any
good.
case, we have to do, we're appointed and confirmed, my colleagues and I do what we think is right.
That's exactly right. And that's why I say it, because I think it's not lost on you that we all want the rates to go down. In fact, it's really real when you say, someone's locked in at 3% at their house, their interest rate, so they don't want to move and get a 7% rate. They don't want to pay that. That's real. My colleagues mentioned that, and that's truthful. And that's why it's so important to be independent. Now, lastly, I do want to ask, because again, it's so darn important to have an independent Fed chair and an independent Fed. Secondly, the dual mandate. I respect the chairman very much, and he's a friend. Hope that doesn't hurt him politically. But that being said, he did ask you a question about the dual mandate in a way that he quoted somebody else and said, is that the way you see it? I do want to see, how do you see the dual mandate? It seems to me that you gave a little bit of a preference to price stability over maximum employment. Is that the case?
No, I think the two things are equal under the law. But if the thought is, we haven't defined it in exactly the way that the chairman said, but notwithstanding that, I do think it's a reasonable way to define it, which is the maximum employment is the maximum level that's sustainable or consistent with price stability over the long run. That doesn't make it, to me, an inferior goal.
Gentleman's time has expired.
Thank you.
I think it's kind of
Mr. Chairman.
implicit in a way.
The chair now recognizes the gentlewoman from Michigan, Ms. McLean, for 5 minutes.
Thank you, and thank you so much for being here. I appreciate it. As a business owner, small business owner myself, access to capital is extremely important to me. So I want to talk a little bit about the Fed's balance sheet and just get a better understanding of how we're thinking about it. I mean, some experts say that the Fed's balance sheet or large balance sheet is distorting the markets and keeping long-term rates, let's say, too low. Also, I think it limits the access to capital, right? Historically, if I'm accurate, the balance sheet's been about 4 trillion prior to the pandemic. Then we raised it, almost doubled it to about 9 trillion. And now it's on a kind of a downward trajectory to about 7.2. Again, if my math is right. Do you think we're on the right track in shrinking this balance sheet?
I do, yes.
I'm trying to get a sense of what the landing spot, in your opinion, should be. Do you think we'll get back to the 4 trillion?
No. So we're in what we call an ample reserves regime. And what that means is that the quantity of reserves, demand fluctuates, and this means the quantity of reserves can fluctuate without affecting interest rates. And we think that's a good thing. What that means is there's going to be a lot of liquidity in the banks and in the financial system. That's a good thing. There wasn't enough liquidity before the global financial crisis. That was one of the problems. We have some shrinking left to do on the balance sheet, but we're not going to get down as far as you asked.
Where do you think we'll land? Because let me start. I'm sorry. Where do you think we'll land?
I can't give you an exact number, but we're going at a pretty modest pace now. We've slowed down, kind of cut in half twice the speed. We think we can go for a good while at this speed, and we'll learn as we go.
So you think the trajectory, so to speak, will remain?
Yes, and I think the fact that it's quite a gradual trajectory now is going to enable us to find that level that is ample and not scarce. When reserves are scarce, you get a lot of volatility, and that doesn't help. So I think that's a good framework. The ample reserves framework, I think, serves the country well.
And you're not concerned in terms of the access to capital? I mean, as a business owner, that's what I look at is I got to be able to get capital. And some people are saying, we're really hanging on to our cash.
I think honestly, I think if you took the trouble to go back to a much smaller balance sheet, it would have no effect whatsoever on capital ability for companies. We wouldn't do that at all. We're not pulling capital away from companies. That's not what's happening. It's just you have a big balance sheet where there's a lot of liquidity. The result is there's a lot of liquidity. Banks are flush with liquidity for the most part, and that actually enables lending. It probably wouldn't have much of an effect one way or the other if you went back to a smaller balance sheet.
So you're comfortable with the liquidity. You're comfortable with the access
Yes,
access to capital. Excuse me.
I mean, we look at credit availability for smaller businesses, and right now conditions are a little bit tight.
Yeah, it's tough for people in my district.
I would say that they're not
tough.
terribly tight, but we do see that there's some tightness. But that's not really a function of the Fed's size of the Fed's balance sheet. That's just that banks are perhaps a little risk averse in this uncertain environment.
I think it all goes together and is kind of intertwined. But I appreciate that. I want to just switch gears a little bit. Are you seeing any signs of financial instability building beneath the surface that we may not be seeing maybe on top of the surface, whether it's in commercial real estate, private credit, regional banking, I don't know, anything you're seeing underneath the surface that could derail the growth path? that
Not
we should-
really, no. I mean, you mentioned, there are a lot of pots that we need to watch to see that they don't boil over. CRE, has been a problem for 5 years. We're working our way through it. I think we're making good progress there. It's not getting worse. It's getting a little better. Private credit is, has its real positive attributes. A lot of it's not funded by deposits, so it's not, as long as it's not funded by retail or by deposits, it's actually fine for financial stability, but it's a very big and fast growing sector, and it hasn't been through a real downturn. So, and it's quite diverse. So I think it bears close watching. I mean, asset prices are high, but leverage is not particularly high for corporations and households historically. It's not particularly high for banks. Banks are well capitalized. So I think overall financial stability conditions are not in a place where we worry a lot.
So we're really poised in a pretty good position economically.
Gentlelady's
I
time
think
has
so, yes.
expired.
Thank
Absolutely.
you, Mr. Chair. Thank you.
Absolutely. The chair now recognizes the gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Mr. Chairman, and Chair Powell, nice to see you again. We had spoken in February about the cuts in some of our economic data reporting agencies, and I think you'd said at the time that you didn't have a concern, but if you would alert us if there were concerns. You mentioned this with Mr. Liccardo, and I gather, if I'm paraphrasing you, I think you said that you're not concerned about your access to data right now, but I think you said that you don't like the direction of travel. I wonder if you could speak to, well, first, I'm going to work under the assumption that as the chairman of the Fed, you probably have more access to economic data than just about anyone in our country. I am more worried about the impact on smaller businesses that don't have your access to data, whether, someone thinking about hiring decisions, looking at regional inflation rates, all the data we get from those resources. How concerned should we be, if an efficient economy depends on, at some level, on equal access to information? How concerned should we be that our business community, with some of these cuts to BLS and elsewhere, is not going to be able to allocate capital as efficiently as otherwise would be in this moment?
The reality is that essentially all the data we use overwhelmingly is public data. The difference isn't that we have more access. The difference is that this is our job, and we follow the data very, very closely. But the employment reports, the CPI reports, the analysis of that by many economists, internal and external. We just spend all of our time on this stuff. But I think large businesses have the exact same.
Well, but I'm talking about
businesses not.
BLS has announced they're cutting 350 indexes. So that data is no longer going to be public data.
That's a different thing. Okay, so if you're asking about that, I don't want to say, and it wouldn't be true to say that we can't do our jobs with the data that we have now. That's just not true. The data overall, we get the data. It's all, these jobs you're always going to make mistakes. It's never going to be certain in any time. But I would say seeing that survey sizes are shrinking and we're seeing more volatility, for example, in the labor market data, lower response rates and things like that, that's not good. We should be getting better and better and better. Yeah. I would add the private sector, by the way, we use more and more big private sector data sets. And that is a relatively new thing.
Sure.
For the last 5 or 10 years.
Yeah, and oftentimes
it doesn't replace the U.S. government data has been the gold standard.
Yeah, and I guess I get concerned because some of those data sets, of course, you have to pay for, and not every business can afford that. I want to, staying on the data point and picking up on what Mr. Himes was saying, I think only a fool would predict they know what's going to happen in the Middle East right now. But I get concerned that we have trying to handicap. The Saudis have been very open that they would like to not see the price of oil get above a point where they're going to lose market share, much to the dismay of U.S. frackers. U.S. frackers have been wanting to see it go the other direction. I don't know how to handicap which group is going to have more impact on Trump right now. But I would like to have some smart person out there taking a position on what is happening in oil markets. And the Energy Information Administration has now announced they're not going to run the International Energy Outlook anymore. Should we be concerned about that piece of data as we think about what's happening in global energy markets right now, given all the pressures between various suppliers of where they'd like to see the price go and the wild card that is Iran and the Red Sea?
I don't particularly know that specific report. You know, I know there are many entities that do data analysis around energy and oil and the availability of it and the price of it and all those things. So I can't speak to that one report.
Okay, well, I mean, again, just my own experience before coming here, I relied a lot on that. And if I was in my past job, I would now basically have to rely on the International Energy Agency, which in general was not as robust as the DOE data. And so it's a gap. And I guess maybe I'll just close with, you know, I think a lot of this gets tied together with the Office of Financial Research, which would presumably be synthesizing a lot of this information for you. Your predecessors, Janet Yellen and Ben Bernanke, both recently urged the opposition to cuts in Office of Financial Research that are in the bill that the Republicans are pushing through. Do you share your predecessors' concerns about the importance of that agency to synthesize some of this disparate things so that you can do your jobs, that the American people can do your job, or do you share the views of the Republican Party that that agency is not necessary?
You know, I'm not going to take a position on the bill, on the reconciliation package on specific issues like that don't relate to us. I will say generally, I'm a big
Gentleman's time
fan,
has
and everyone at the
expired.
Fed is a big fan of good data collection.
Gentleman's time has expired. The chair now recognizes the gentleman from Montana, Mr. Downing, for 5 minutes.
Thank you, Mr. Chair. Our national debt now exceeds $36 trillion. Congressional Republicans have made it our mission to rein in out of control spending, from repealing the Green New scam, enacting common sense Medicaid and SNAP reforms, and rescinding wasteful spending. Mr. Chairman, you've repeatedly said our national debt is not currently at an unsustainable level, but it is on an unsustainable path. Can you describe what the point of no return looks like when our debt reaches an unsustainable level?
So there's no way to know exactly what that is. But ultimately, if the debt is growing substantially faster than the economy, by definition, at some point it will not be sustainable. So, we don't have oversight responsibility over the fiscal authorities, but that's traditionally what my predecessors have limited themselves to saying, and I'll say it too.
And what effect would that have on the economy?
So you'd see rates go up. It would be very challenging to. I think if you wait too long to fix the problem, you'll have to fix the problem eventually. If you wait too long, it'll be much more painful.
Yes. I believe the US dollar status as the global reserve currency is essential. It allows the US to borrow at lower costs, which stimulates economic growth and increases standards of living. The Trump administration is actively negotiating to ensure we are no longer taken advantage of by our trading partners. At a previous Monetary Policy Task Force hearing, all of the witnesses agreed that the recent volatility in the Treasury markets did not permanently damage the dollar's global reserve currency status. Do you agree?
I do.
Thank you, sir. Let me turn to oversight of the Federal Reserve. I certainly believe that had the Federal Reserve responded faster by raising interest rates earlier to combat the inflation crisis of the previous administration, that interest rates would not be as high as they are now. I hear frequently that from my constituents that they're increasingly getting priced out of the housing market while interest rates remain near record highs despite the rate of inflation coming down. So, Mr. Chairman, I appreciate the Fed's increased transparency under your leadership, and you've always welcomed congressional oversight into the Fed. And I also appreciate the comments you've made about the limits of our knowledge demanding humility. So with that in mind, can you point to oversight practices of other governments into their central banks that could be replicated with the Federal Reserve?
That's an interesting question, and I want to think about that. I'll come see you and we can talk about that.
Thank
I think
you, sir.
we have effective oversight from this committee and from the other committee in the Senate, and I think that's important.
Would you be supportive of an outside independent group of analysts or economists that conducts a periodic review of the Fed's economic assessments and modeling?
So those are ideas I'd like to think about and discuss privately before.
So do you have any other ideas to increase oversight in the Federal Reserve?
I think, like my predecessors, I've fostered, more and more transparency at the margin, and I think that's appropriate. I think transparency is critical if we're to maintain our democratic legitimacy. So I've tried that, but I'll devote some more thought to that question.
Well, I look forward to following up, and I thank you for your responses. And on that, Mr. Chairman, I yield.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Gonzalez, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here with us today. I understand commenting on some policy issues or outside of your purview, but I have one that I think is heavily impactful on the American economy right now. And I want to underscore the scale and impact of the ICE raids that we're seeing across the country. Pew Research estimates that over 10.5 million undocumented individuals live in the United States, more than 3.3% of the population today. And according to the nonpartisan American Immigration Council, removing this workforce could cost the U.S. economy between 1.1 and 1.7 trillion in GDP and billions in tax contributions, including 22.6 billion in Social Security and 5.7 billion in Medicare funds that are increasingly critical as our population continues to age. These are resources that are paid by these undocumented have been here for a long time. Many of them have been here for a very long time. That's why I plan to introduce the Save the American Workforce Act, which would establish an employee-sponsored temporary work authorization for undocumented immigrants who have been in the country for 3 years or longer and have never been in any kind of trouble, no criminal liability or nothing else. Additionally, last week I sent a letter to President Trump urging him to halt indiscriminate deportations and issue an executive order that would do exactly what my bill does to protect American businesses that need a workforce. We have something, the last I heard, I think we have 7 million open jobs. We have a record low unemployment, which is great, but we have 7 million open jobs that we cannot fill by American workers. What economic consequences would we face if these individuals were removed from the workforce, even further hurting the situation that we're in? Could this disrupt even more the economy even more severely than what we experienced during the Great Recession?
So, as you might expect, Mr. Gonzalez, immigration policy is just not for the Fed to comment on or to, let alone make, and so I'm reluctant to engage with you on that.
Okay. Well, okay. I want to talk to you something a little differently. We have, and this is a banking issue. Banks are making, billions of dollars of construction loans across the country that are timelined, and contractors are not able to fulfill their obligation because they don't have the labor force in the middle of the jobs to finish. I mean, I'm hearing stories in Texas, at least, where people are pouring concrete at midnight. Are y'all having any kind of conversation with the administration on how this could impact the economy and our GDP?
So we have very deep connections all over the country through the reserve banks, and we hear some of the same stories. But for us, we're not the policymakers here. We don't report this to the administration. We don't just publicly have a view on it. It just is what it is. So
yeah,
we're our responsibility: maximum employment, price stability. Many other factors affect those goals, but we don't make those goals. We don't make the policy in those extraneous areas, which include things like energy, for example, or immigration, or fiscal policy, or any number of things. We try to stick to our knitting because that's how we remain independent.
We're living such unconventional times that I would love to have that. It would be great if y'all were having those conversations in the administration. But moving on, the U.S. dollar has also long been the world's dominant reserve currency, but that position is facing growing pressure. As of 2024, BRICS nations led by China and including Brazil, Russia, India, and South Africa have stepped up efforts to reduce their reliance on the dollar in global trade. China, for instance, has expanded the use of the yuan in energy transactions and cross-border payments, while BRICS is actively developing alternative payment systems that could erode the dollar's global role. At the same time, inconsistent and unpredictable economic policies from the White House have contributed to a drop in the dollar's value, now at its lowest level in 3 years. What risk does a weakening dollar pose to our economy, particularly to U.S. borrowing costs, inflation, financial stability, as China and BRIC nations expand their efforts to challenge the dollar's global dominance?
So, by long agreement and custom and tradition, the Treasury Department has responsibility for the dollar and dollar stewardship. I would say we also, are involved in payments policy, and we're very aware we and the other major central banks are very aware of other payment developments and, working on ideas to make sure that the payment systems that support the dollar and other, other
Gentleman's
major
time's
currencies
expired.
of the democracies are well supported by that infrastructure.
Thank you. I yield back.
Gentleman's time has expired. The chair now recognizes the gentleman from Florida, Mr. Ardopoulos, for 5 minutes.
Thank you very much, Mr. Chairman, and thank you, Chairman Powell, for being here today and answering these questions for us. It's very much appreciated. Looking back over the last few years, I think the question a lot of people have been asking me as they really were suffering through the challenges with higher prices across the board. I know they got as high as over 9% inflation in 2022. And there's a lot of discussion about, was it Ukraine? Was it transitory? Was it post-COVID? What was the reason? As you look back now in those years, and this is your field of expertise, if you look back and you're teaching a history class, what would you blame the increase in prices on back at that time period?
So I'll start with the fact that it was extremely global. So we saw there literally was a point at which not a single country in the world had inflation 2% or below. So it was everywhere. So you have to look to common factors. And I would say that the pandemic and the closing of the global economy and then the reopening of it, in all cases with some support, that's a big part of the story. Clearly, though, there's a role in that for fiscal policy. There's a role in that for monetary policy. And I like to think all of those factors were involved. And but when it happens everywhere in the world, you can't look to one thing. You got to look to a common factor. And I think that common factor is what happened around the pandemic.
Sure, good. And build on that idea, I hate it Monday morning quarterback, but if you had to do it over again, you had this opportunity, as you know, the rates stayed pretty flat in 2021 as inflation creeped up. What would you do differently today if you had the opportunity to look back and make some changes?
I have perfect hindsight in this.
Yes, sir, if you had it, yeah.
Sure. So I would have raised rates a little earlier. I honestly don't believe it would have made much difference to the outcomes, but we would have looked a lot smarter. But that's something I would have done. The other thing is, ultimately, we did get all the way back to 2% inflation just about without having a big increase in employment. So that was not at all expected. So I don't know how that would have affected my behavior, but somehow things really came out much better than everyone had anticipated. Was that it would take high unemployment to restore inflation, but it didn't.
And the other pressure point that I hear a lot of people talking about is this idea of the tariff issue. I've heard for months now that the sky is falling, but it seems at this point, at least, that the inflation rate is pretty steady. And how many months of steadiness do you need before you might look at an even larger rate cut from the 4.33 I think we have today?
Yeah, so you're right. Inflation, the non-tariff parts of inflation that we've been working on for 3-4 years are behaving really well. And that was our forecast, but it's good to see it coming true. I would say we expected that tariffs take a while to work their way through the distribution chain, several months. And I would say we would expect to see meaningful effects, kind of June, July, August. And if we don't, we'll be learning something. We have a highly adaptive, flexible economy, and it's certainly a possibility that the tariffs that we expect will come through in a much smaller level. We can't know that until we actually see it, but I think we'll be learning as we go. And if we see that, then that would lead us to want to cut earlier. The other thing that would lead us to want to cut earlier is if we actually did see some weakness in the labor market of a troubling nature. And we don't see that. Those are the two things we'll be looking for.
And the last question I'd ask is, at that same time period where, as you put it, the global issue of inflation, I get that. But at the same time period, there's pretty radical increase in spending in 2021 by the federal government. What factor did that play in the inflation level?
Certainly a factor, I would say. As I mentioned, fiscal policy definitely played a role. I think if you take a step back from those things, what happened was demand came back so much stronger than we expected. You remember, if in late 21, early 22, you had the pandemic still going on, Omicron going, was it 21? Yeah, 21 into 22. And demand was just much stronger than people expected. And by the way, the supply side was much slower to recover. So that's the labor force, that's all of the snarled up supply chains. The supply side took a long time to recover and demand was much stronger. That story created the high inflation. Behind that, tariffs, fiscal policy played a role, the spending did, monetary policy played a role, and the pandemic.
But you would agree
played a
that
role.
the government spending did play a significant role in that as well?
Yeah, I would say that. Yeah.
Thank you. Thank you, Mr. Chairman.
Gentleman yields back. The chair now recognizes the gentleman from Illinois, Mr. Foster, who's also ranking member of the Financial Institutions Subcommittee for 5 minutes.
Thank you, Mr. Chair. Following up actually on Rep. Gonzalez's line of questioning. So in addition to your dual mandate, do you believe that that preserving the U.S. dollar and the primacy of the U.S. dollar is part of your job description?
I think it's something, it's not formally part of our job, but yes, it's something that we care about. And we certainly wouldn't want to undermine that. But that's really, Treasury has the primary role around the dollar. That's been the case for some time now.
Yeah, I was just wondering how you deal with the sort of worldwide drop in investor confidence in dollar-denominated assets. Frankly, due to a president who kind of disregards conventional economic theory and whose answer to nearly every question seems to be, "Well, I haven't decided yet," or "Maybe I'll give you an answer in a couple of weeks." Maybe I'll just comment. It must be challenging. Now, one of the things I've been very concerned about is, in terms of the job market, is artificial intelligence and the coming impact there. We're seeing predictions by the leaders of the leading AI firms that within 1 to 2 years, a majority of entry-level white-collar jobs will be gone. And there are products that are being released to market that propose to do pretty much exactly that. And I anticipate pretty high uptake of those things to essentially eliminate back office operations in small businesses, things like that, or intermediate sized businesses. And we're already seeing layoffs in the big tech firms. Microsoft had a big round of layoffs where 40% were computer coders and maybe another 20% supervisors of computer coders. And so I was just wondering, what sort of analysis is the Federal Reserve doing about that job shock, and how is it going to affect your dual mandate when it lands, perhaps as early as the next year or two?
So I think economists everywhere are doing work analyzing the potential implications of AI for employment and some of the very things that you mentioned. And we're certainly both consumers and producers of that kind of research. And don't think anybody, I certainly can't make any positive statements with great confidence about what will happen, but there's certainly a possibility that at least at the beginning, AI will replace a lot of jobs rather than just augmenting people's labor. Over a long run, the history shows that generally new technology raises productivity and creates new jobs over time, but it can be disruptive in the very short term. And AI, anyone who's been exposed to AI has to be kind of stunned with what it's capable of. And you think, if you think, oh, this is just the beginning, they say that 2 years from now, the things you're looking at will be left behind by the continued development. So I think it is certainly everything you would want in a transformational technology. And I think that unknowable, but certainly to be important effects on the labor market. And I hear the same things you mentioned from CEOs, that they can see a way to significant reductions in employment, but I don't think we know that.
Yeah, but the question is, are you developing a playbook for this shock? Part of your job is to look at tail risk, and this is probably not even a real tail risk at this point. A lot of the CEOs think it's more probable than not. You're seeing law firms just not hire the same number of junior associates just across the economy. Are you actually developing a playbook in case the shock is real, and what you may or may not be able to do with monetary or other policies?
The playbook is really in your hands and in the private sector's hands. We will be trying to maximize employment, and that will be what we do. And we'll try, at the same time, we maintain price stability.
Yeah.
So we don't have the tools to. You're talking about transitioning people into new jobs and new lives, and
before AI wipes out those new jobs you're retraining them for. Yeah, okay. Well, but think about it. I urge you to think about it, and what you will do when that job shocking. So last week, Fed put out a request for information on ways to mitigate check and payment fraud. Despite a decline in the use of checks, check fraud is really very prevalent. And I was happy to join Chair Hill in sending you a letter and other banking regulators, as well as FinCEN, urging action. Can you summarize what you have in mind doing in response to that letter, or what you've learned when the outreach that resulted from it?
So this is on the check fraud thing. I just know we just started a request for information, and I think we're starting a process of gathering a bunch of information,
Gentleman's
really
time has
focusing on
expired.
that issue.
Okay, and if you could say what you're actually going to do in response to that.
Gentleman's time has expired.
Thanks.
Thank you. Yield back.
Gentleman yields back. I now recognize myself for 5 minutes. Chair Powell, we've discussed this several times before, but the issue remains, so I continue to raise it. I sent you a letter several months ago urging you to seek public comment and permanently revisit the SLR and ESLR, particularly given the constraints current calculations places on market participants' ability to intermediate in the Treasury market. I'm glad to see that you're meeting tomorrow to discuss the issue. And I know you've discussed this with Mr. Flood. I want to clarify a couple of things. The last time you testified before the committee, you said you were concerned about the levels of liquidity in the Treasury market, and that one obvious thing to do would be to reduce how binding the SLR on intermediate capacity. Are you considering changes in the SLR and ESLR, and will you consider exempting treasuries and reserves from the SLR and ESLR?
So I do think we've effectively raised the capital tax on all kinds of intermediation activities, and that certainly includes Treasury market activities. So I've long favored leverage ratio reform, and so we're putting out a document for comment, which will seek comments on one particular proposal and alternatives to that proposal, as I mentioned earlier.
Which I think answers my next question, which will you look at changes at the leverage ratios that constrain a bank's ability to participate?
Yes, that's the idea.
In your view, would allowing netting mechanisms for derivatives on treasuries encourage participation in the market? And would you consider looking at that with your prudential counterparts?
This is for derivatives. My first phone call on that would be to Vice Chair Bowman to ask her what she's planning, but I'm certainly open to that conversation.
Absolutely. Let's discuss the framework review. You've said that the review of the consensus statement is complete, but potential changes to communication strategies and tools may continue into the fall. When can we expect the framework review to be complete, and will you provide opportunities to receive feedback from members, industry, and the public on any changes the board is considering?
So the framework review, there are two parts of it. There's the consensus statement, which contains our monetary policy framework, and then there's communications. On the first, the framework, we've had the meetings that we needed to have to talk about the employment mandate and the price stability mandate and how we might change the framework. Now comes the discussion between participants on the committee, all 19 of us, about exactly what language to use in the new framework. And we're just entering that phase between these two meetings and at the July meeting, and hopefully we will be able to announce something near the end of the summer. And I expect that will be, and by the way, we've talked about, we've laid this out a little bit in the minutes as we go.
One last question. The NPR notes that the FOMC's policy deviates from the first difference policy rule. Will you provide a justification for why the FOMC decided against that path?
Against the first difference rule? Well, as you probably know, there are 5 rules that we talk about there, and the first difference rule is the one that calls for a price hike. The other 4 say that we're in the right place. So the Taylor rules generally are very supportive for where we are. It so happens right now. First difference rule is a very interesting concept, which we can talk about online, which has a lot of appeal, but it can be a little bit volatile too. And right now it's calling for a rate hike. The other 4 are calling for us to hold our policy where it is.
The irony. Thank you, Mr. Chairman. I yield back the balance of my time and I turn to the gentleman from Oregon, Mr. Bynum, for 5 minutes. Ms. Bynum for 5 minutes.
All right, thank you, Mr. Chair. I want to start off with just kind of a foundational belief I have. This big, beautiful bill is trash, and it's actually increasing our costs. So, but thank you for being here today. I was just back home and saw firsthand that businesses across the country, across my state, are worried about inflation and rising costs. And particularly for our state where we make chips, we import, export agriculture, and we have apparel. So just want to level set there. My Republican colleagues have actually been focused today on asking you to lower interest rates, but they're seeming to ignore the market chaos that the president has caused. So my first question is, it's my understanding that one of the key responsibilities of the chair of the Federal Reserve is to stabilize prices and fight inflation. Is that right?
Yes.
By my count, the President Trump, has changed or announced a new tariff or a delay of previously announced tariffs 19 times. And so has the president's ever-changing tariff made it easier or harder to stabilize prices and fight inflation?
So I by practice, never comment on things the president does or says.
Has the administration's policies on tariffs?
Or the administration.
Has the change in policy on tariffs made it easier or harder?
So it's not up to us to judge these changes. These are things that elected politicians get elected and do, and it's just not our job. You know, our job is to provide stable prices and maximum employment to the public, and that's what we do. So we do expect there will be a set of price increases from some of the price increases from tariffs will flow through to the consumer. We don't know whether that will be persistent or how large it will be, and so right now we're kind of in watch and wait mood until we have a better sense.
Is your sense that back to school will be affected, the holiday season would be affected? You mentioned it a little bit earlier on how you didn't say the exact time frame, but you thought maybe a few months we would start to see changes from
Well, I think
tariff
we're going to be
impacts.
learning as we see. We'll get before the July meeting, we'll get a inflation report well before that. And, you know, we're going to be looking to see, we expect to start to see meaningful increases through the goods channel. And if we don't see that, then that'll be telling us something. We'll be learning from that. And by the way, we'll also be looking at the labor market. If it weakens unexpectedly, we'll be looking at that too. We will continue to adapt to the evolving situation as we have been doing.
Thank you. So what market conditions would make it so that the Federal Reserve would be able to lower interest rates, which would also lower costs?
So as I just mentioned, I would say if we were to see that inflation is not coming through as our forecast and other public forecasts have suggested, that would push us in the direction of being able to cut sooner. Also, if the labor market were to weaken, that would push us in the direction of being able to cut sooner. I think if the opposite happens, if the labor market remains strong and we do see higher inflation, I think we will still get around to cutting, but it would be later rather than sooner.
What do you think American families are expecting from the Federal Reserve?
Stable prices and maximum employment. That's what we want to deliver. And, you know, we want people to feel so confident of price stability that they never think about inflation. That's where we were for a very long time. And we've made a lot of progress back to that place, but we're not quite there yet. And we're gonna finish that job.
Is there a plan that the administration has presented on how it plans to lower costs as opposed to providing tax breaks for billionaires?
Again, it's really not up to me to discuss the administration's priorities or policies.
I'm going to quickly switch gears here. It seems to me like you're under a lot of pressure from the president to address the national debt. True, false?
Sorry?
Are you under pressure from the president to address the national debt?
So our role is maximum employment and price stability. Fiscal policy is the responsibility of Congress. And so it's not really within our ambit.
I think that despite all of the talk about national debt, the this big, beautiful trash bill. Continuing to do that will actually raise the national debt. So thank you for answering the questions today and continuing to work to lower costs.
And the lady's time has expired.
Thank you.
Thank you. The chair now recognizes the gentleman from Kentucky, Mr. Barr, who is chairman of the Subcommittee on Financial Institutions for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for the generosity of your time. We're at the witching hour, but appreciate your endurance. And with respect to my friends, the gentlelady's line of questioning, would a recession that would potentially result from a massive tax increase, a $4 trillion tax increase, would a recession help the debt and deficit picture?
No. Tax receipts would go down and all that.
Yeah, so I think this sky is falling scenario about the one big beautiful bill, we have to put into context, and I'm not asking you, Chairman Powell, to comment on this, but this is my editorial response to my colleague. A massive $4.5 trillion tax increase that would put us into a recession is not a recipe for fiscal discipline. Chairman Powell, let me switch gears to tariffs. Governor Waller argued in a speech earlier this month that tariffs might result in just a one-time price increase as opposed to increasing long-term inflation expectations, especially since this Congress has not pumped massive spending into the economy as Democrats did under President Biden. On this issue of a one-time price increase versus inflation expectations, do you generally agree with Governor Waller's analysis?
So I do agree that basically, if things are a one-time increase, then you don't respond to them. That's the whole idea. Is there's a shock to prices. It could be an oil shock, could be a tariff shock. Generally speaking, you don't respond if you are highly confident that it will just be a one-time shock. I think the current situation, though, is a complicated one, and I think a number of my colleagues and I feel like it's a decision we need to take with some care. And the reason is because we're not at price stability. In 2018 and 19, when the president's tariffs were put into place, not only did we not raise rates, we cut rates 3 times that year because the tariffs were so much smaller. These tariffs are many times larger, and they do raise kind of more concern. In 2019, we hadn't had high inflation in 30 years. Now we're only a few years reduced away from high inflation. So we think that they may well prove to be a one-time thing, but in the meantime, it's a decision we want to approach with some care.
I think we've made a lot of progress towards getting closer to that 2% goal. Does the Fed take into account the disinflationary fiscal policies like supply-side tax cuts, deregulation, and more energy production that could be a counterweight to whatever one-time price increase that might materialize as a result of tariffs?
So we look at aggregate inflation, not any particular kind, and I'm very gratified at the performance of services inflation, which has come down now. That was the very sticky inflation. So I think overall the inflation picture is actually pretty positive.
Chairman Powell, we're looking forward to this rulemaking later this week addressing Treasury market liquidity. Can you talk about how banks are constrained from holding U.S. Treasuries and other low-risk assets on their balance sheet as a result of these restrictive leverage ratios?
Yes, when banks are bound by the leverage ratio, when that's the binding capital constraint, then that's going to make low risk, low return assets, something you don't want to hold. And so lots of fairly low risk intermediation, including Treasury market intermediation, gets taxed to the point with capital requirements that you just see less of it. So I've always thought that it would be better if we had a leverage ratio that was a backstop rather than the binding thing. And that's what this proposal is going to do.
Well, let me preemptively thank you and Vice Chair of Supervision Bowman for working on SLR reform to accommodate more bank holdings of treasuries to stabilize our treasury markets. Finally, I'm pleased to see that the Fed joined its interagency counterparts and announced that you no longer plan to consider reputational risk in your examination process. Senator Scott and I introduced the FIRM Act to stop the weaponization of the supervision process, to stop the targeting of politically unfashionable groups. Our bill requires regulators to focus on the true risks as opposed to political factors. What was the Federal Reserve's thought process in implementing this common sense reform?
That it's common sense. And, I think this is an area where we learned over the last couple of years that there really was a problem here. The reports were louder and louder and more troubling. So we just thought, let's take this off the table. It may have been
Gentleman's time has
unintentional on the part
expired.
of banks that there was so much, it was just such a
Gentleman's time has expired.
fraught issue that banks turned away people with they didn't intend to discriminate. That's what the banks.
Thank you for helping
Chair
to
will
depoliticize the
announce
banking
to the
system.
membership,
I
we
yield
will
back.
recognize Mr. Torres and Mr. Loudermilk, then adjourn for our 1 p.m. agreed to hard stop time. And with that, the gentleman from New York, Mr. Torres, is recognized for 5 minutes.
Thank you. Chair Powell, you spoke about elevated uncertainty and declining sentiment in the U.S. economy. Do you believe, as I do, that the economy would be in a better position but for the elevated uncertainty and declining sentiment created by the Trump tariffs?
I don't want to be criticizing policies. I will say uncertainty has.
Is it fair that it's fair to say that the policy created uncertainty?
It's fair to say uncertainty was very elevated, but it's also fair to say that uncertainty has actually come down since the peak, if you will, in April. I think there's a different feeling out there now than there was 2 months ago, and it's more constructive feeling on the part of businesses, which you must be feeling too.
But it's higher than it otherwise would be in the absence of the Liberation Day tariffs. To what extent was the elevated uncertainty a factor in keeping the Fed from cutting interest rates?
So I think that's part of it. The truth is, we were cutting rates, and we paused in January and haven't cut rates since. And really, the reason is that we, like other forecasters, do expect a fairly substantial wave of price increases to come through to the consumer and to measured inflation. We've always said the timing, amount, and persistence of all that is highly uncertain. I think we hadn't expected to see it until now. We now begin to think it is time for us to be seeing that. And if we don't see it, that will matter. If we do see it, that will matter. So we've just taken a cautious approach to not moving our policy rate until we have a little more confidence about the size and likely effects of that.
Chair Powell, following the so-called Liberation Day tariffs in early April, we saw something the U.S. economy had not seen in decades: a flight not to the U.S. dollar as a safe haven, but away from it. And since President Trump's inauguration, the U.S. dollar index has fallen by nearly 10%, marking the worst first-half performance for the dollar since 1986. At the same time, Japan, America's largest sovereign creditor, just saw the worst 20-year Japanese government bond auction since the 1980s, raising fears that it could reduce its holdings of U.S. treasuries. Given these developments, do you believe, as I do, that the U.S. may be transitioning from a period of dollar dominance to a period of dollar decline?
Well, let me say, the Fed does not have responsibility for the dollar. That's really the Treasury. But
I'm asking for your analysis.
I wouldn't make that statement. No, I think things have been volatile. The markets are digesting things, and I think the Treasury market's been fine by many measures. The dollar is still.
You feel the safe haven status of the dollar is as strong as it's ever been?
I think the dollar is still the number one safe haven currency, and I don't think it's. I would say these narratives of decline are premature and a bit overdone.
I want to ask about the debt. The big, beautiful bill would have ugly consequences for our nation's finances, adding more than $2 trillion to the debt if the provisions are temporary, and far more if made permanent. We've accumulated World War II levels of debt, not during a world war, but during peacetime. Interest payments on the debt have become the largest item in the federal budget after Social Security, surpassing Medicaid, Medicare, and military defense. To what extent is the U.S. at risk of entering a debt spiral in which rising interest costs lead to ever larger deficits, which in turn lead to ever larger interest costs?
Yeah, I think that the U.S. federal budget is on an unsustainable path. The debt is not at an unsustainable level right now, but the path is not sustainable. And I think the sooner we deal with that, and by we, I mean you, the better.
The Trump administration has championed the unitary executive theory, the notion that the president has absolute power over all entities that wield executive power. That theory, if taken to an extreme, would all but abolish the independence of the Federal Reserve. If monetary policy became nothing more than an expression of presidential will and whims, what havoc would that wreak on the U.S. economy?
I think that independent central banks have proven over time to be a valuable and critical institutional practice. And I think that is because basically advanced economy democracies around the world have given their central banks a degree of operational independence. They assign them goals. You go do this and you stick to those things. But we'll let you, you may choose the means of achieving those goals. It's called instrument independence, but not goal independence. And I think it's a very
Gentleman's time has expired.
very important practice.
Gentleman's time has expired. Chair now recognizes our last member of the day, the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Well, thank you, Mr. Chairman. Chairman Powell, it's good to see you again. And I'm going to be brief, so maybe we can get out of here right at time. As some of my colleagues know, I chair the bipartisan payments and fintech caucus along with a fellow Georgian on this committee, Representative David Scott. And in the past, you and I have talked about payment-related issues like FedNow, but today, I'd like to ask you about the failure of Synapse Financial Technologies, a third-party service provider that connects banks with non-bank fintechs, and what it means for the bank and the non-bank ecosystem. Last year, a dispute between Synapse Financial Technologies and Evolve Bank and Trust revealed a shortfall in customer savings deposits of $65 to $95 million. There are still thousands of individuals who are not able to access their funds, including some of my constituents. So the question is, could you provide an update on what the Federal Reserve is doing to ensure that customers regain access to their funds? And is there anything that the Federal Reserve is considering to help prevent situations such as this going forward?
So I don't have a lot of specifics for you on that. I am assured that we're still very much doing everything we can to try to get people their money back and to avoid similar occurrences.
Okay, well, I said I was going to be brief, and that was a brief answer. So with that, I yield back, Mr. Chair.
Gentleman yields
Thank you.
back. The chair would like to thank Chairman Powell for his testimony today, and without objection, all members will have five legislative days to submit additional written questions for the witness to the chair. Questions will be forwarded to the witness for his response, and Chair Powell, please respond no later than January 29, 2025. This hearing is adjourned.